glad to have you here. And the group here got me talking about a fund that I'm launching this week. Um, and they have lots of questions. And so they are also, honestly, when I was doing the research for my fund, I think that's when I came across your fund and reached out to you.
Awesome.
And so I watched your webinar and enjoyed it and reached out, and now you're here. So this is Jeremiah Boucher. Is that how you say your last name?
Boucher, but yeah,
Boucher.
close.
Okay.
Like Bobby Boucher. Yeah.
Bobby Boucher. That's good. I lived in France for a number of years, so I'm always hesitant on using a French pronunciation. All right. Why don't you introduce yourself, and thank you for being with our group. Looks like we've got a good number of people in here. We've got 70 people in the room. Welcome to the Alternative Investing Club, and let us hear a little bit about your story. If people have questions, go ahead and put them in the chat, and I will judiciously interrupt Jeremiah. And Jeremiah, if you want to make this more of a dialogue and a conversation, I'm always open to that too. If you want to just, talk and give your presentation the whole time, I would guess we'd say semi-formal. I was admonished not to be too informal.
I'd like it a dialogue. Yeah, I'd like people to chime in. I don't want to just hear my own voice the whole time. And then if we have to get into PowerPoint or anything else, I can. But let's just talk if you don't mind.
Sure. Do you have a presentation that you want to share, or is it just talk?
I do. Jeannie can do that. She's going to pop in, but I'd rather just give it the intro and the discussion, and then I can go over the macro items here in terms of the state of the industry.
Okay, great,
and thanks for giving me the platform. So, all right, guys. So I'll get to the heart of it, and then time-wise, Daniel, in terms of just so I'm cognizant of everybody.
Yeah, we go till 1 p.m. Pacific time.
Okay.
And Intel, most of the people in this group are from Intel because that's where the club started. And Intel is very much meetings happen on the half hour and the hour. So people will drop off pretty much at 1.
Okay, great. I got it. Now, so we'll hop right into it. I think, Daniel, what I heard from my team, maybe the attraction to what I was doing is alternative commercial real estate investing. I've been in it for 20 years. What that means is I bought manufactured housing communities over the last 15, 16 years. And now we're heavily weighted into investing in storage, self-storage, and tertiary or secondary markets. Why I like the asset class, and I think it's a great trend in general as a good asset class to invest in, is it has diversified streams of income. So you are targeting the largest segment of America in terms of the demographic of people that use storage. Over 10% of people in this country use it. Affordable housing in terms of manufactured housing. There's, I think, 1 in 10 or 2 in 10 people actually live in a manufactured house. So we don't quite see that on the coasts, but it's the most affordable and highest quality of product out there for affordable housing. So, and with that, the asset classes have matured pretty quickly, but still they're in an infancy stage. So the manufactured housing has gotten a lot of unique press over the last 5 years or so. A lot of new investors in the space, and that's kind of changed my direction of how much I've allocated in our funds to go get and acquire these assets. A lot of abuse in terms of just raising rents dramatically and not really doing anything in return, and using cheap interest rates to buy these assets and flip them really quickly. So overall, though, what's nice about manufactured housing, if you guys just want the basic foundation of it, is the land lease community model. When Sam Zell, the owner of Equity Lifestyle Communities, who just passed here, and one of the godfathers of real estate, he bought these back in the 70s and 80s throughout Florida and California. And the true value model is in the land lease model, where you don't want to own the homes. You want the best infrastructure possible in terms of people leasing their lot, and you have good roads, good utilities, and really all you're responsible for is making people abide by the rules. And then in terms, you keep quality housing and quality tenants in that community, and it's a great asset class if you can have that type of quality of community. And then as you've seen, I'm sure just that you can get dramatically worse. But in terms of rent growth, in terms of demand, more than ever, even people are now living in RVs if it's allowed by the municipality or state. So it's a large and growing asset class that continues to grow. So it's something that I would keep my eyes on as an investor. And then also on the second side of things is self-storage. And when I say self-storage, we do have a small amount of small bay industrial, which there are metal warehouses, and we provide some space for commercial tenants at a small scale, 1 to 10,000 square feet, where they get a bathroom, they get an office, and it's kind of an incubator space for them, or a business park per se. At about 10 to 15% of our assets are in that space. But essentially, storage is month-to-month leases. You guys, I think, all know what it is. There's different grades or levels to storage. There's the multi-story massive facilities you see outside of urban markets. And then there's the single-story drive-up models around suburban and tertiary America. We found a lot of success in actually buying in resort markets. So I'm originally from New England. And I don't want to get into my whole investing story here, but we have 70 assets up in New England. And I learned the hard way, losing everything in 2008 by buying and selling homes and realizing, I don't have a niche in this market. I don't have an edge. And that's the book I wrote. It was Finding Your Edge, How to Win at the Game of Commercial Real Estate. So I realized I needed some type of competitive strategy. So with manufactured housing at the time being a really poor quality of asset class that people didn't want, I got in early there. And then on the other side is in self-storage, where, a lot of these suburban or tertiary markets, a lot of the big companies, the big public REITs, there's really now only 3 of them left. It's Life Storage. Oh, actually, it's just Public Storage, Extra Space Storage, and CubeSmart. And then U-Haul is there, but not their truck rentals as well. They're starting to consolidate, and they're getting excited about buying facilities or groups of facilities in these suburban or outer markets. But why so? The trend with self-storage is during COVID, there was massive need, massive demand through displacement, through social shifts in where people can work and how they live their lives. So there was 20% revenue growth and rent growth year over year for the last 2 years. Well, 2 years of COVID. The last year, it's kind of tailed off and it's getting back to normal. But it really accelerated the learning curve of the middle America, the grandmother in Vermont, where using a QR code, putting your credit card in online, and signing a lease through your phone is now the standard. And 3 or 4 years ago, in parts of the country, people still did not abide by those rules. So it gave the industry an opportunity to open up its customer base and reduce the operating costs of all the labor. That's why a lot of the bigger public REITs they all have on-site managers and a big extensive overhead, because they wanted to have that in-person feel for how they were working in terms of with their customers. So now the customer doesn't need that, and the growth curve has grown. So the industry is evolving very quickly, where technology is helping reduce costs. There's bigger margins, but it's still quite competitive. So at this stage of the market, we're seeing rent growth grow flat, and that's okay. But then that industry is like the hotel industry maybe 10, 15 years ago with Expedia and those sites. It's really dynamic pricing that changes daily based on demands. So that's where the real power is with self-storage. Is you constantly want to be managing your revenue, because if you're at above 92, typically 95% or higher in occupancy, you want to continue to drive those rents on your existing customers so you can maximize every single dollar out of every square foot that you have in that facility. So that's where the strategy is here. And right now, you'll see the strategy is get people in at all costs for almost free. I mean, get them in for free, give them free rent, do whatever it takes to lure them in there, because we all know if you've ever had a storage unit, it's a nuisance item. It's really not that fun. And it is definitely something where once their stuff is in there, you have traction, and it pretty much stays there until you finally get fed up with it and move it on your Saturday. So Dan, you can come in and just interrupt me if you want to. And it depends if you have anything.
Well, at this point, we don't have any questions in the chat. I'm just going to turn it back over to you, unless, do you have a question, Glenn, that I missed? Oh, you do. I'm sorry. Uh, Glenn says, is the benefit of the P&L for storage predominantly driven by labor force reductions in tech and automation, or into tech and automation? Or are there other operating levers besides macro, like inflation?
Yeah, it is a very good question. So with storage, there's a few levers on that P&L. I think the number one is the revenue management. So the Wall Street term that everyone likes is the WALT. The weighted average lease term is very short. So yes, it keeps up with inflation versus having a 10-year fixed lease. Now it takes a lot more hands-on management. That's the effect on the expense side. But then in terms of the expense side, yes, that is, I think, still a trend where reducing costs, where expense ratios run around 30% on an asset, sometimes in 28%, sometimes 35%, depending on property tax. But yeah, there's room there to lean that out through technology over the next few years. And then the other side of it to clean it up is really, I think over time, it's going to be keeping the revenue, just driving revenue. We don't know where the cap is. So we don't know the true demand. And we're still finding out that people are getting married later in life, some of the sociological trends, people working from home, people running a business from home, or working out at home, so that there's no room. So yes, we're still seeing where that demand curve meets the supply. And that's really, biggest enemy in storage is supply. You want to find markets where that are barriers to entry are high and you have lots of population. And then the last side of it would be in terms of marketing. I mean,
Did we lose your sound?
Yeah, I think somebody was cutting in on my phone there. But overall, we do see really a shift. Well, I mean that we can go on for days, Dan, about that. But I don't know if Jeannie wants to pop up the presentation, and if you can let her share, or
Sure.
or I can.
Yeah, and I think anybody can share. So please, okay. Non-speakers don't share. Also, Don has a question, and he says, I may have missed it, but what's the average annual return on manufactured homes and/or storage, either for a given property, fund, or other configuration?
Yeah, that's a great question. Now, institutional grade, I can speak to cap rates, so I can't really speak to returns of investments. But we've seen a compression of cap rates on those assets, drop down competitive with A-class apartments, believe it or not. I mean, it's crazy where per lot you're selling over $100,000 per piece space, which is in the past never happened before. That doesn't include the unit. So we're seeing cap rates on quality communities in urban markets still sub 6, even with debt at 7. So I know you guys, as investors, LPs, you're all looking at it. It baffles me, but debt is higher than the yields on these assets, and because there's so much capital chasing high quality assets in good markets. So for now, we haven't seen cap rate expansion. And then secondly, on storage, I would say a subprime manufactured housing community, we are seeing that where they're more difficult to operate. That's getting in that more high 6, mid 7s. So there is a delta there that we're starting to see creep up because of the operational nature and less competitors in the space, because you actually have to run communities and deal with a very challenging tenant base. And then secondly is on the storage side, we've seen, same thing with quality assets, multi-story near urban markets, still sub 6, maybe creeping up in the low 6 cap rates. But with debt at, over 7 right now, we're starting to see the same tertiary assets and some of the more rural assets, that's pushing into the 7s on a yield. So we're seeing that creep up, but not the choice assets right now.
Hey, so 2 questions here. So why do you think you're continuing to see cap rate compression? And just to translate that means the value of the property is going higher. Why are values in storage going higher? And is it because there are a lot of other sectors in commercial real estate that are starting to slow down, and you're starting to see money transfer from those areas into storage more, or is it an increase in hype? What do you think the cause for the increase in money going into the market is?
That's a good question, and Jeannie, I don't know if you can show that slide on the last recession in 2008. So I think there's multiple reasons there where the diversified streams of income are very important for in terms of investors looking at safety. So right now, there's a lot of dollars still chasing good hard assets, and so the last recession there was only a 3% decline in asset values versus all the other asset class types. So the protection side of things, the safety side of things is number one. I think number two is right now with these assets, there's low capital expenditures. It's a very clear and simple business. And a lot of these short-term leases do outpace inflation. So a lot of investors don't want to get into these long-term fixed assets that have lots of inflation. And then three, it's like the whole Amazon effect and the way that sociologically people are working from home or however they're having families later in life. You know, retail big box is not what it was. We all know that. You know, office is not what it was. Definitely not. That asset class has gotten hit hard. So that capital, Dan, is definitely allocated towards alternative assets that are a lot more appealing now to larger institutions.
Yeah. It's interesting. We've also seen a decline in home ownership rates over the past year or two, and I imagine, you know, as people are downsizing from their home to maybe an apartment, you know, the storage becomes a part of their life.
It is. It is, and you know, it's a relatively new industry. It started in the 70s, well, late 60s in Texas, but early 70s in San Diego and over in LA, it was Public Storage was kind of the pioneer of it and really grew it and pushed it and created customer awareness. And what was interesting, we just had the storage show here in Vegas, the big national one, and one of the big public REITs that we sat down and had dinner with was, I was surprised to hear, and they control all the data, is the Millennial is the fastest growing and highest use demand of storage. So we were concerned that they were throwing things away or they didn't really have an attachment to material possessions. And that is definitely not the case. So they are ingrained with their things and they are not getting rid of them. So that is creating, you know, we don't know where that threshold is on how much people are going to use. But if you go to the next slide, Jeannie, that's going to give us a better understanding. If you keep going, what I thought was an interesting slide, keep going, is 2%. Keep going, sorry. Keep going. 2% or less. Keep going. Of people's income is allocated to storage. So they're not using a lot of their budgeted income right here, where it's a very small hit on their overall, and this is nationally across even the bigger markets. So it's still a very affordable opportunity for people to get a space to rent versus housing. And we all know apartment rents and housing continues to go up dramatically. So you can't just buy more house or you can't just buy more land. Inflation is outpacing what space is costing them on a median income level. So if I want to go back, Jeannie, just to where I can try to add value to the group is if we look at, you know, the public storage, keep going in terms of, here we go. So the REIT performance here, if you guys, I'm sure you all have equities. And you know, if you want to look, I follow the public REITs pretty closely because my thesis, and I'm not talking about my funds per se, but it's just I would like to aggregate and then sell and everything to a public REIT in the future. So I follow these guys closely, and they really dictate the trends. They are the institutional benchmark. And what they're doing, their stock prices obviously dropped because if you guys invest in REITs, the higher the interest rates are, the lower these REITs value is because the worse they perform. They have a lot of floating debt, not a lot leverage, but portion of their debt is floating. So that does decrease their dividend yields. So what's interesting though here is that they maintaining occupancy and their values, their stock prices have, I would say, dropped by 10, 20, 30%, depending on who they are. But what I believe they're doing is that outlook is just, they're just maintaining this occupancy so they can ratchet up the revenue over time. So if you could go to the next slide, Jeannie. The industry still looks bright. So, you know, right now, obviously population's growing. And like I'm saying, usage is growing. Now 11% of the population is growing. And if you look at increasing occupancy, median occupancy across the big players, I mean, average is 92.2. So you're seeing a trend over the last 15, 18 years plus. It goes, median occupancy went from 78% up to 92%. So you can see that people are definitely utilizing the space, and developers are ambitious to grow it. But with the cost of debt right now, and with the challenges of land prices, and with permitting with COVID, even staffing in terms of local municipalities giving you your permits and your zoning and your approvals, there's still a lag here on new supply. So I'm hopeful for the industry. I think there's really good long-term trends that it's going to do well. I mean, I like the stock prices. I mean, just for my personal portfolio, and I think that there's value to be created over time. And where I think that you guys, in terms of looking for emerging funds or opportunities, would be finding aggregators, people that are getting boots on the ground, finding that are working with mom and pop owners, where they are at this, I'm sure you guys have seen this baby boomer phase out of small businesses, and private equity firms aggregate these businesses like funeral homes and like dentistry offices, where you get a private equity fund, and in terms similar to ours, where you go in and you buy some of these mismanaged storage facilities or mismanaged assets where they just don't want to reinvest the capital. Nobody wants to learn the technology. Nobody wants to really get dialed in and providing a good service for people, where you're picking up the phone and you have a really good interface with online for people and an easy way to pay. So there's a lot of assets sitting out there that, the big guys, they're not going to deal with that. That's not anything that they want to deal with, the woman in very rural America. And it's, challenging sometimes to do business, but there's value there. And that's something that, we're excited about. And it's something where I think that there's still only, I think it's 25 to 30% of the assets are aggregated with the big players. So 70% of those assets are with mom and pop owners. And I would say a good 20, 25% of those assets are prime, that there's a lot of value to create. Was there a question, Dan?
Let's see. Glenn is asking, what do you use for modeling prices on units? Do you raise rates based on CPI, GDP, or something else? Or is it pushing higher and constantly testing supply and demand?
Yeah, it's so the big players, the extra spaces in the public storages, they have, I think, 12 to 18 revenue managers from MIT. Or they're the best math stats guys out there. So for us, we try to follow their model, just seeing their trends. But there's an industry where there's 2 or 3 really good subscription services that I wish I would have developed that. That's where your real money is. So it's a SaaS model. They scrape the pricing every single day. It shows up on our reports. So we do a weekly and monthly review on our prices versus the competitors. So the good thing is with ours is they're not very savvy, our competitors, in a lot of these suburban or tertiary markets. But what we do is we're comparing, like, what's the class, what's the grade of our facility, meaning, does it have gating? Does it have fencing? Is it paved? Is it good lighting? Is it a good appeal? And what is that compared to the competition? And then how do our initial offerings, our concessions, or our like discounted initial entry price compared to theirs? And then what is our long-term rents compared to theirs? So we're constantly evaluating the data, and what we don't need to be the low price leader in a lot of our markets, because the product is really, really rough in some of the competition there that we're competing with. But to answer your question, we have to change those rents a minimum of once a month. If you're not doing that, you're not keeping up, because you're right, it happens quick. If in a recession, I think that we are now, or I'm feeling it, I'm seeing our customers, a lot of people are moving out. So you need to make sure you're adapting your pricing to recapture those tenants coming in, and then using that, they call it a existing customer rent increase, ECRIs. That's where you take your existing customers and ratchet up those rents, so you're getting that sweet spot there with revenue.
Hey, Jeremiah, out of curiosity, what services are you using there, that the pricey ones you mentioned?
So Radius, it's called Compass Radius Reports. That's who all my staff likes, my underwriters and my acquisition team. It's not too bad, but it's still $1,000 a month, $12,000 a year. And then also we use, we just got a new one with housing starts. It's called Track IQ.
Oh,
and then, yeah. And then there's another one called Store. I don't use it. But yeah, there's another competitor on there too.
Yeah, I think you're right. There's a lot of money there with the subscription models.
Oh yeah, yeah. And just so this is an off topic, but Blackstone bought this company called Storage. It's called Storable, and Storable bought up all the softwares that we all manage our storage from, and now they control credit card processing, and they store a third party called Sparefoot that actually they market in addition to our facility marketing. They like control Google AdWords, and then we have to pay them a fee to get tenants to move in because they beat us on the SEO. So it's like it just got consolidated with the software that Blackstone is like controlling all of it for us, and it's very challenging to we're not going to build our own, so we just kind of have to take it in the rear. So next slide, Jeannie.
Anita, really quickly, is asking who would you say are your top 3 to 5 competitors?
So for us, they're mid-sized private equity for us, and ones that you can look at to compare funds that are out there. You got your REITs, you got the 3 or 4 public REITs, and then you got this mid-tier. Reliant has a big fund. We're obviously Patriot Holdings. There is. I don't know all the names of these guys. Cedar Creek Wealth. Jeannie, if you know any that we hear them all the time, but yeah, I would typically say that the archetype of that would be someone that's raising anywhere between 25 and $100 million in some type of fund structure, and going out and allocating. Right now deal flow is down quite a bit, but going out and it's a GPLP structure there, and trying to go buy between 50 and 150 million of assets a year, and that's more challenging to do. What we're seeing is like the Blackstones and the bigger private equity firms, they are focused right now. They sold some of their storage to the big public REITs. So because they're seeing it is very hands-on, I think they bought it at the peak of the market. So they actually consolidated and bought business parks from Public Storage, and then they sold Simply Self-Storage to Public Storage. So they swapped these different asset classes. So yeah, if that gives you any context. And then we do compete with some of the local investors in some of our markets, but they typically don't know how to operate the asset. So that does give us a nice competitive advantage over time, where we can come in and raise rents and get better occupancy. So if you look on here, I mean, yeah, and we can send this presentation to everybody, but it's just the performance of storage did really well over time, and the REITs have performed on an institutional level, have really exceeded equities in terms of 20 years annualized growth. And I'm sure that they'd probably pick these stats to make it look solid, but I think even if you look at it from any perspective, it has outperformed very, very well versus all equities, because you're following a trend that continues to grow. Next slide, Jeannie. And you guys can look at this as well, but this kind of shows manufactured housing and self-storage as just really, really strong returns over time. And it's just a very, very good asset class because it's a diversified streams of income that target all demographics, or most demographics. And I see here, there was this, Dan, was there a question on there about, you can go next slide. There we go.
Yeah, there's a question. Glenn is asking, in self-storage, what's the typical investor model? Are these value adds? Are they primarily income generators? And he says, I guess you said your ultimate exit path is to sell to a larger company. So I assume it's an equity-based exit.
Correct. Yeah. So to speak to some of the maybe smaller operators in the whole scheme of the market or the asset class, it is, for us, it's a value add strategy, because there's core plus investors, but typically, even with the amount of capital they have to deploy, the big public companies or large private equity firms are gonna be looking for more of those stable, low return assets, and then giving their 4% dividend. On our end, we have to target an 8 to 10% dividend or distribution, and we target a 20% IRR. So over a 5-year life of a fund. And we've done that performance over the last 10 plus years, but it really takes, you sacrifice the amount of deals you can do, and there has to be a value add component. So typically what I see is it's a little bit smaller than the big institutional assets. So we have to double the size or add on square footage to our facilities because there's a little extra land. And we have to know that there's some increase in rents. And we have to know that, with occupancy, people are not marketing effectively and they're not really filling it up because they're not building a good product. They're not improving the product. And loan, just our typical facility takes at least $200,000 in capital expenditures, which the pro here is the benefits of self-storage is like you see on here is, once you finish your paving, you have your solid roofs in there, the buildings are metal buildings. Sometimes you'll have a little bit of climate control, which that has a little bit of an HVAC element. But overall, the reinvestment in the asset to keep it in good operating condition is very minimal. That's what really excited me about this asset class is the predictability of the income once you get it stabilized. So yeah, value add is our core strategy for sure, Daniel.
All right, I'll let you go on with your presentation and bring up questions towards the end.
Next slide, Jeannie. Yeah, next slide. We targeted that one. So this was that slide I was targeting there. It's just that recession resilience. The decrease in asset value in the Great Recession was minimal compared to all the other asset classes. So we really like that. I think the big thing to look out for right now, and as you guys evaluate all types of commercial real estate investments, is floating debt, because anyone's debt, either not even floating, but even maturing debt, as that debt becomes matured right now, it's very challenging to be able to refinance that property out because rates are 7+, versus sub 4, 3 at some level. So that to us, with value add, and one thing that I do, which, I won't do it forever, but I personally guarantee almost all of our debt, because our projects are smaller than the 5 or 10 million minimum that many of the larger institutional debt providers would want, like a Wells Fargo, a Bank of America. And there's that value add component where it's not fully stabilized. You don't walk into covering great debt coverage day one because you have to do the things to actually increase the revenue. So our local lenders throughout the Northeast, fix that debt for 5 years. Our rates are really competitive. We're still in that high 6 range. We typically work off of Federal Home Loan of Boston plus 200 or 300 basis points as the spread. So we have a better rate, and we have fixed debt, and they're more accommodating to roll that debt out longer term, out to 10 years. But right now, if you're looking at sponsors in multifamily or at some other asset classes, and their debt's going to come due in the next 1 to 2 years, there's a possibility of a capital call because you just can't get the value. You can't get the appraised value to cover the cost of taking out that initial debt because, just because the asset may be valued in the market higher, the lenders are very conservative right now because you got to get that 1-to-5 debt coverage ratio that they have to comply with. So that's a big thing for us, is just making sure our debt's in place, and something that I would look at if you guys are looking for a protective strategy on your portfolio. Next slide, Jeannie. I was talking about the trends of COVID, and I think you're seeing this across all at least asset classes that I'm dealing with, is there is a come down. There is no more funny money, I think, stimulus money that I know of, unless unless something else happens. But there was some crazy projections and growth, and I felt like a lot of the sponsors got bailed out. And I'm not saying that I'm always, perfect here. I got lucky in terms of really exceeding what I ever thought on some assets with how fast the industry grew, but that is normalizing. You're going to see that in the stock price and revenue growth, NOI growth. It's all, we're getting it's starting to turn back to the normal market trends of 3 to 4% revenue growth, really possibly 5%, but it's same as inflation. So you got to be a good operator. You got to, if you're looking at anyone to invest in, what do they do in terms of their value strategy, their operations, maintenance, how they provide a easy experience for the customer through technology. And that shows you right here. I mean, it's out of control. I mean, I've never seen this in my lifetime, where how fast revenue went up in 21 and 22. And that's on a public level. So it's just like, if anyone has apartments or a rental home, I don't think you ever would have imagined you could raise your rents by 20% 2 years in a row and your tenants stayed. That was pretty unbelievable there for this type of this increase in valuation. Next slide, Jeannie. So for us, I mean, I still believe storage is a regional focused asset class. You better know your markets. There's different trends in terms of consumer behavior. Traditionally down south, for some reason, people utilize more storage per square foot or use per person per market. So for some reason they have a higher demand. I don't know why, but that's just what that behavior is. But also in different regions, there's different geographical trends in terms of, you can't build in certain areas just due to topography, due to land value. So you better know your markets. So for us, it was better off that we consolidated and went after those regions that we knew our customer, and we liked our region because it was very consistent and stable. Good steady job base up in the Northeast, lots of universities, skilled jobs, diversified income where you have older money there and still good jobs with public companies that people are still growing in revenue in terms of they're getting better wages. But we're not getting the population growth. So that is the con. You got to be careful. You're going to see most funds target Sun Belts, Florida, Texas, not so much California now with what's going on there politically or whatever's happening with tax wise. But you're seeing a lot of the funds for storage following growth, which is excellent. But it's no secret that all the other competitors are following it as well. So I would rather look for long-term systemic increases in good quality jobs. Cost of housing is high and barriers to entry. So what makes a good asset for us is, you guys can look at this criteria, but we just have a template where it's got to fit a certain population growth, a rent growth. It's got to be built after a certain age. Right now, the worst thing I think you could do as an investor or sponsor is go deploy capital in a really heavy lift asset where you should not need to stretch. I mean, right now you should be looking for things that are cash flowing now or or cash flowing at least at a break even, and you can improve rather than doing a huge development project or a remodel of a Kmart or an old mill in the Northeast. You don't want those projects because you're eating up precious capital, where I believe there's going to be more and more opportunities ahead of us because debt is so high, and people with the cash that actually can go deploy it and actually operate the assets are going to have that advantage because the funds aren't getting the type of capital they could before to go deploy. Dan, was there questions on taxes? Because I would want to touch on that here.
We do. We actually have a couple of questions coming in from the usual suspects, Glenn and Ashish. But there is one with specific to tax credits and depreciation benefits from adding solar to the top of these. Is that a profitable thing to do in order to boost your NOI now?
Yes, it is. That's funny because I've gone to these solar conventions at the storage convention for the last 6 years, and it's been it's just a confusing mess. I can't figure it all out because sometimes people want to release your rooftops. Other times, each state has a buyback law where you can only utilize the solar that's on top of your building to offset your utility cost versus the state regulating if the utility company can buy the additional solar. But what we've noticed in New Hampshire and some of our markets in the Northeast, we did find a model that works out really well, and we're looking at USDA grants to help with that, to help offset the cost. But the yield would be an 8 to 10% yield on cost on adding solar plus the tax benefits. So we're pretty pumped up about that, and I could do something differently or send this out to people. But it's actually a AI-based panel where it's just fancy way of it moves with the sun in the Northeast, and it's still cost effective where you don't put it on the roof. You actually have 48 panels on a moving arm, and we install it in the foundation or next to our buildings, and it doesn't obstruct our customers. We set it at least 14 feet high so trucks can drive underneath. And then secondly, in terms of tax advantages, we always like this, and this is something you definitely want to look at with your competing funds. All the depreciation benefits are allocated to the LPs. So in the past, because storage is a pre-engineered, pre-manufactured building, so what that means is it's essentially a Lego kit that we buy from Wisconsin or down south in Tennessee. So we just do all the site work like we did there in Rutland, Vermont. That's our storage that we built and expanded onto. That's an amazing project. I'm very happy with it, the one up top there. We just build the pads, meaning the 6-inch concrete floating slabs, and we pave it. And then the company, we already buy the buildings pre-erected, so you can move walls in there. They go in and pre-made, and then we erect them there on site. So that way, why I bring this up is because it's a gray area in the IRS code, and I'm not saying that we're definitively have it all figured out, but it does qualify for bonus depreciation, and that allowed us to accelerate it and pass that on. So investors in the past were able to get up to a 2-to-1 loss. So if they invested $100,000, they were able to get $200,000 loss in that calendar year. It's gone down a little bit with the benefits of bonus depreciation decreasing as it's starting to phase out, but it's still there, and it will be less. But it's a great aspect of investing in storage.
I'm curious what other opportunities you found in order to put auxiliary services onto the site, like installing a solar tower or having billboards or vending machines. How else do you gather income off your sites?
I learned a lot. I grew up paving from my father. He has a paving company in New Hampshire. And what I noticed from him and learning from the big public companies as well, really the thing you got to focus on is rent per square foot. Don't get cute and don't try to do a lot of other things because it diverts the core focus of the company. But to your point, Dad, is the solar is a legitimate opportunity if you can get it structured in the state and you have security around that buyback program that you can generate revenue. And we would like to have that green initiative that our company is committed to. But overall, it's very prohibitive now to get permits for signage. I mean, we have a hard time getting our own sign on there at this stage. So yeah, and cell towers. Well, what we hear with satellite technology, that if you're not heavily already in the game, it's a really competitive space that if they approach us, we'll do it. We have a few, but we don't focus on that as something we develop.
Sure. Ashish is asking, do you do a separate capital raise for your solar installations?
It's literally brand new. I mean, I could, if you guys want to Danny, you want to introduce me to someone, I can present that to anyone that's interested. And that it could be a possibility in the future. And if there's any insight, I would love to hear some. But by no means am I an expert. I know storage and I know manufactured housing. So this is just an additional revenue source that helps with some tax benefits. And it's a good quality image for us and the environment.
All right. Glenn is asking, in delinquencies, is the liquidation of units a measurable, either positive or negative part of your financials?
It is. That's a good question. And delinquency is another really part of your management company that you need to focus on. In terms of getting anything of value in those units, no. So there's no such thing as whatever that storage wars is. Like, I mean, I think I got a kayak once, which was pretty awesome, but I didn't even get it. I don't know who got it, but there's nothing of value there. So what we do is there's online platforms that make the process very easy. And what we have noticed is at least some of the state regulations are allowing us to evict quicker. So we typically give people a 30-day grace period to pay. We do lock them out after the 5th day, and then they have to pay in order for them to get access back into the unit. But overall, if you could keep that over 30 days to 3% or less, you're doing a good job. And we do like late fees. I would say more than that, late fees are a nice line item because just the demographic that's the perfect storage customer is someone between 60,000 median household income and 100,000 median income, because they have enough money to go buy a lot of stuff. They don't have enough money to go buy a big house, and they don't have enough money to throw things away. And they don't plan very, very strategically. So it's a very reactive customer, and that is our sweet spot where we love that market.
Maybe even if you don't find things that are of a lot of value in those units, I bet you find some interesting things in those units. My grandfather once had a boa constrictor left in an apartment that he was renting. So there's some fun stories there. But we've got 2 minutes
people
left.
Trying to live.
Yeah,
we're trying to live.
We've got 2 minutes left. Can you give your contact information? And I've got a few last minute questions. Ashish is asking, can you recommend some of your favorite public or private REITs? Who do you follow?
Yes. Yeah. And I have some interests with them. So I just do have to disclose that we haven't publicly released what we're doing with some strategic partnerships. But I am a big fan of what Extra Space Storage is doing. I really like how they're adapting as the industry is changing. So Extra Space Storage is strong. Public storage is still a monster in the industry. I think for safety, they're not going to go wrong. And then CubeSmart, I would say, is probably the one I don't know about, but so I would look at those other two. And then Life Storage was just consolidated by Extra Space, so that's a mergers occur, or it's already occurred. But I would follow those two stocks pretty closely.
And then last question, I guess, unless any more have scrolled in. Nope. Do you see any government or regulatory risk coming into the industry in the near future or currently?
Yeah. So for manufactured housing, that was one of the other challenges for me. And just like in New York State, I had communities there and was able to sell before rent control occurred. But yes, especially for a special designation of manufactured housing. So yeah, rent control is alive and well, and it's going to continue to increase. So I'm very cognizant of that. Secondly, for us, we'd like to develop it over time. It's not easy, but I do understand how to develop these communities, and it's a different talk, but it's of high value. And then in terms of the storage side of things, I think for the business commerce storage, small e-commerce, small business services, and our residential customers, judges don't really have much of a sympathy or a heart for people's stuff. So I think that's going to actually become more liberal. I am not concerned at all about rent control there.
Okay, great. So everybody here, could you take yourselves off mute and thank Jeremiah Boucher for speaking?
Dan, patriotholdings.com is our company, just so people can reach out and get more information. Jeannie Bazaar's on here, Jeannie at patriotholdings.com. I don't know if so I think it's JEANIE at patriotholdings.com. And then also Finding Your Edge, How to Win at the Game of Commercial Real Estate. I think my book's like $12. So I'm not trying to sell it. I really like what I put out there. I really wrote it. It defines the strategy and the story. And then also the Audible book comes next week. And I painstakingly did that in the studio in San Diego in a really weird place. It was a Zen mix studio where they typically do like spiritual books, but it was pretty cool. So I finished it and it was a good vibe. So I think I expressed myself, and I think that people will really enjoy that.
Awesome. I threw your link into the chat for everyone. Hey, you guys, can you take yourselves off mute and thank Jeremiah for being here today?
Thanks, Jeremiah. Thanks, Jeremiah.
Thanks, everybody. I really respect what you guys do.
Thank you.
Thanks a lot.
Yeah, nice work, Jeremiah.
Yeah, thank you,
Keep
Jeremiah.
building great stuff for us to all use.
And if you don't mind, I'll follow up with you a little bit offline too.
All right. Thanks, Dan, for the opportunity. Appreciate it, guys. Everyone.
And we'll be back next week and the same time. If you want to see what the schedule is, go to alternativeinvestingclub.com. Catch y'all later.